What time frame should I use? This is a question that I get a lot for any kind of trading strategy or trading system. It really depends on many factors, but I suggest you to try different time frames with this strategy and choose the one that best fits your personality and your availability. If you are a very calm person, you don't like to open many trades in the same day, you probably don't want to trade the 5 minutes and the 15 minutes charts. The same if you have a job from 8 to 5 and you only have the evening to dedicate to Forex trading, you probably don't want to trade short time frames because you don't have time to monitor them several times per day. Having said that, I'm here to help you to choose the trading style that is perfect for you. The first category of traders that I want to show you is scalper. Scalpers usually hold their trades from a few seconds to a few minutes. The goal is to get a small amount of pips per each trade. Scalpers usually focus on very low time frames like 1 minute or 5 minutes at most. This technique is a double-edged sword because it is true that you can earn money in seconds, but you can also lose money in seconds. Also, you need to consider that for small targets, the spread has a bigger impact on your positions. In addition, low time frames are very hard to read and have many false signals. If you are at the beginning of your journey as a Forex trader, I would not suggest to start from here. The second category is day trader. Day traders focus on short and medium term trading, usually holding their positions for less than 1 day. The main time frames used by day traders are 15 minutes and 1 hour. If you are a kind of trader who has time to trade, who likes to trade during the day but doesn't like the crazy fast action of scalping, then day trading is for you. Last category is long-term trader. Usually this category is also subdivided in swing traders and position traders. Swing traders usually focus on 4-hour and daily charts, but sometimes they also like to use the hourly chart. I'm a swing trader, for example, and I mainly trade the 1-hour chart. Position traders give more importance to daily and weekly charts, and they usually hold their positions from several days to several months. I have studied and tested this strategy, the strategy that we're going to study in this course, with any time frame. I mainly trade it with the 15 minutes and the hourly chart. I have once opened a long-term investment that I published on my Twitter page using this strategy on the weekly chart. There is no perfect time frame for this strategy, there is only the perfect time frame for you. So spend time to think about it, try to trade all the time frames to understand which one is suitable for you, and then you're ready to apply this strategy successfully. I want to start this lecture with a study from Baby Pips. A group of traders analyzed the results trading different indicators on euro-dollar for 5 years. Each indicator had a well-specified setup with rules to enter and exit the trade. These are the results. Only the Ichimoku and the MACD were profitable, with the Ichimoku getting a much better result in terms of profit in pips, profit in percentage, and maximum drawdown. With this, I don't want to say that the Ichimoku is the best indicator ever and you shouldn't use the others or even have a look at them. I want to say that the Ichimoku is a complete indicator. While most of all the other indicators struggle to succeed alone and they need something else to build a strategy, the Ichimoku is considered a complete indicator, an all-in-one indicator. If we have a look at it, we have different lines. These lines give entry points, support, resistance, direction of the market, momentum, and much more. So you have everything in just one indicator. That's why I do not suggest to use the Ichimoku together with another indicator. I'm okay if you want to use the Ichimoku together with price action, for example candlestick patterns, but I don't think that it is useful to add another indicator like the MACD or the RSI, because it's likely that the Ichimoku already contains the information that the additional indicator provides you. The Ichimoku is an all-in-one indicator. You can really study all you need with it, so I don't want you to wait anymore. In the next section we are going to be a bit more technical, so let's get started with the Ichimoku Kinko Hyo. How to calculate the Tenkan-sen? First of all, let's spend 10 seconds to understand the name. Tenkan means conversion, while Sen means span. So the Tenkan-sen is the one that on TradingView is called conversion line. We will simply refer to it as red line because I think it is easier. How do we calculate the Tenkan-sen? How to calculate the red line? I don't really mind if you don't remember the name, but it is important to understand how it is calculated so we can understand how it works. The formula is highest high plus lowest low, everything divided by 2. Now we need to define a period for this formula. Highest high and lowest low for what period? The standard parameter for this line is 9. This means that the 2 points are calculated over the last 9 candles on the market. We are going to leave all the parameters like the original setup, so we will leave 9 for the red line. Many traders get confused here and find no difference between the Ichimoku Tenkan-sen, the red line, and the moving average. I haven't met a single trader or author so far who could explain the difference. In every book or video you can check a tutorial on YouTube, for example, I guarantee you that they always say that the difference between the moving average and the Tenkan-sen is that the moving average is applied to the closing prices, while the Tenkan-sen is an average of high and low. I believe that this is a very dangerous concept for your trading with the Ichimoku, and we should erase this concept from your mind as soon as possible, because trading a moving average and trading the Ichimoku red line are two different things and we can't treat them in the same way. Let me explain the difference between these two lines. First of all, you don't necessarily need to apply the moving average to the closing prices. You can apply the moving average to the average of high and low as well. It is called the median price. First of all, let's find the moving average. And here you can see that there is HL2. This is called the moving average applied to the median price. If you check the formula of the Tenkan-sen, highest high plus lowest low divided by 2, it looks the same of this one, HL2, that is high plus low divided by 2. The difference is actually very important and it has direct implications in the use of the red line. The red line takes the last 9 candles as a range, checks the highest price in this range, adds the lowest price in this range, and everything is divided by 2. The moving average applied to the median price calculates the high for this candle, adds the low of the same candle and divides by 2. Then it goes on and proceeds with the next candle and does exactly the same for all the last 9 candles on the market. It gets 9 different prices, one for each candle. The ultimate value then is an average of the 9 prices. So let me say it again. The Tenkan-sen checks the highest and lowest prices in the last 9 candles as a range. Once it finds them, highest price plus lowest price divided by 2. Very simple. The moving average applied to the median price calculates highs and lows for each of the 9 last candles and then performs the average of them. This changes everything. You can see that the Tenkan-sen sometimes is flat, it's just an horizontal line sometimes, while this never happens for the moving average. As we will see in the next lecture, and more importantly we will clearly see it with the blue line, this changes everything and we can't treat the Tenkan-sen as a normal moving average, but we need to define different conditions and use it in a different way. The Tenkan-sen or red line is calculated over a period of 9 candlesticks, so you can understand that it is a very fast line and it is mainly used to detect the short-term trend. Let's check this chart. The trend is up and the red line is clearly showing that. You can see that the line is going up, suggesting an uptrend. There are other 2 scenarios to analyze, when the line is flat and when the line is heading down. When the line becomes flat, it means that there might be a trend inversion. In this case, we will not do anything. If we have a position on the market and the red line turns flat, we will leave our position on the market, even if the line is warning us that the short-term trend might change. Last scenario is when the line turns in the opposite direction. So here it is going up and at one point it changes direction and starts to go down. This means that the short-term trend is already changing. Since the red line is calculated on a very short period, 9 periods, you will see the line changing direction quite often. The short-term trend is changing, but this doesn't compromise our trade. It is not a positive signal, but it's not the end of the world. We can keep our position even if the red line is going in the opposite direction of our trade. For each concept or method to trade the Ichimoku indicator, I will give a grade based on the importance of that concept or that method. So at the end, when we have a look at the complete indicator, we know what is fundamental, what is just important and what is not so important, and so we can avoid to use it for our trading. I give to this method of trading the red line a grade of 3 out of 10, so we will not use it for our trading. Another method to trade the Tenkan-sen is the crossover with the price. If the price crosses the line from below, it is a bullish signal. If the price crosses the line from above, it is a bearish signal. Once again, since the red line moves very fast, we might see these signals quite often, and many of them are just false signals. So I give to this method another grade of 3 out of 10, and we will not use this for our trading. Last method to trade the red line is to check the intersection with the blue line. The same concept of the crossover of the moving averages. We will talk about that method when we will analyze the blue line. How to calculate the Kijun-sen? The Kijun-sen is the blue line on our chart, and I want to take 10 seconds to talk about the name. Kijun means criterion, standard or basis, so it is the one that on TradingView is called baseline. Let's start from the formula. The formula is the same of the Tenkan-sen. Highest high plus lowest low, everything divided by 2. The period is different though. Here the period is 26, so it considers the highest high and the lowest low for the last 26 candles. Once again, you can see from the chart that it is different from the moving average, especially because it has these flat periods here or here that are not a characteristic of the moving average. We will see how to treat this line in the next lecture. How to trade the Kijun-sen. The first method is simply to follow the direction of the blue line, because it expresses very well the direction of the price. Moreover, one of the most important strengths of the Kijun-sen is that most of times it can distinguish between a retracement and a trend reversal. This is a very important point because many traders make mistakes on retracements. It may be that they have a good position, then there is a retracement and they decide to close the position because they are scared and can't really tell if it is just a retracement or the market is changing direction. With the Kijun-sen, you can see here two examples of price retracements, here and here, but if you have a look at the blue line, it is flat, it's not going up, it's not changing direction. When the line is flat, it means that the price is either in a congestion phase or it is just retracing. But unless you see the blue line changing direction, you should assume that it is only a retracement of the market. It is not a trend reversal. This is a fundamental concept and we will enter positions only when the blue line is in the same direction of our trade. I give to this concept a grade of 8 out of 10. Let's add the red line now. Some traders like to trade the two lines, the red and the blue line, just like the moving average crossover. So if the red line crosses the blue line going up, it is a buy signal. If the red line crosses the blue line going down, it is a sell signal. Or in general, when the red line is above the blue line, you have a bullish market. When the red line is below the blue line, you have a bearish market. Honestly, I have backtested this setup and still continue to monitor it while trading with the Ichimoku, but I found out that this condition is not super important. I give to this method an importance grade of 4 out of 10, so we can use it as a confirmation if we have some doubts, but it is not a fundamental condition. Let me remove the red line now. Last method to use this line is with the price. When the price crosses the blue line from below, it is considered a bullish signal. When the price crosses the blue line from above, it is considered a bearish signal. In general, I agree with that, but too many times I've seen the price crossing the blue line just for a few pips, like here or even here, and then the price resumes the trend. So I will say that when the price is above the blue line, we have a bullish market. When the price is below the blue line, we have a bearish market. I wouldn't talk about signals in this case, because the price crossing the blue line alone, without considering other factors, can't be used to generate signals. So we will use it more like a condition to analyze the market. I give to this method an importance grade of 5 out of 10, so it is important but not fundamental. How to calculate the Chikou span, the light green line. Chikou in Japanese means delayed effect, and it perfectly makes sense because the Chikou span, that is the light green line, is simply the current closing price shifted 26 periods backwards, so into the past. It is very clear if we use a line chart instead of a candlestick chart. You can see that it is just the current price but 26 candlesticks back. Personally, this is the only line that I evaluated for a period of time to change the parameter. With 26, you compare the current price to the price of 26 candlesticks before. I believe that 24 is a number that makes more sense in this occasion. For example, using the hourly chart, 24 candles represent exactly one day, so you compare the current price with the price of the same hour but referred to the day before. 26 candles are 1 day and 2 hours instead. So it makes sense in my opinion to try 24 as a period, but in my experience I found that 26 is also a very reliable period, so I keep 26. In addition, some platforms like the MetaTrader do not give you the chance to change the parameter for the Chico span, so you can just leave 26. If you have the chance to change it, you can try 24 or you can try another parameter if you have a valid reason to change it, but for this course we will keep a period of 26 candles. How to use the Chico span, the light green line. This line is important to compare the current price with the past price. Let's start with checking how it is usually used, and then we can understand why. When the Chico span, the light green line, goes over the price, it is considered a bullish signal. When the Chico span goes under the price, it is considered a bearish signal. Now, this line is just the current price, so if the light green line goes under the past price, it means that the current price is going lower than the price of 26 candlesticks ago. It means that compared to 26 candlesticks ago, the price is now trading lower. This has more or less the same concept of breakout. The green line is simply saying, hey look, the current price is breaking the price formed by the candlestick of 26 periods ago. So compared to the past, the price is lower and it might continue to trade lower. This line, and in general the idea that this line expresses, is quite clever, but it is lagging, and most of the times when the crossover with the price happens, you already missed part of the market movement. You can see here that the crossover happens on this candle when the current price is here and the market already had a good down movement that you missed. That is why this line should not be used as a signal provider, but as a confirmation of the trend. You can't base your trading only on a comparison of two prices, but you can use it as a confirmation. I give to the Chico span an importance grade of 4 out of 10, so we will use it only as an additional confirmation, but it won't be a required setting to open a trade. How to calculate the Ichimoku cloud. The Ichimoku cloud is also called Kumo, that is the Japanese word for cloud. The cloud has two lines called Senko span. So we have Senko span A, also called up Kumo, and Senko span B, also called down Kumo. To see how the cloud is formed, we need to have a look at the formula of each line, each Senko span. The Senko span A is Tenkan-sen plus Kijun-sen, everything divided by 2. So it is an average of the two lines that we have already seen in this course, the red line, the Tenkan-sen, and the blue line, the Kijun-sen. For the Chico span, that is the green line that we have already seen in this course, the price was shifted 26 periods backwards in the past. The Senko span A is shifted 26 periods but forwards in the future. We will leave a period of 26 without even trying 24, otherwise we will lose the connection with the Senko span B. The Senko span B is highest high plus lowest low, everything divided by 2. Exactly like the Kijun-sen and the Tenkan-sen, the red and the blue lines, but here the period is 52, twice the period of the Senko span A. As for the Senko span A, even the Senko span B is shifted 26 periods forward in the future, and in the next video we will see how to use this important indicator. How to use the Ichimoku cloud. First of all, having a quick look at the Ichimoku cloud, you can immediately see that there are two colors. The cloud can be bullish or bearish. When the Senko span A is above the Senko span B, we have a green color that indicates that the market is bullish. When the Senko span A is below the Senko span B, we have a red color or orange on my MetaTrader 4 that indicates that the market is bearish. We can have a look at the color of the cloud at the current price and the color of the cloud in the future. So 26 periods shifted forward. Of course, it would be better to have the same indication, so if we are looking for a long trade, it would be better to have a green color of the cloud at the current price and shifted 26 periods forward. If I had to choose which one is more important, I will say that the color of the cloud in the future is more important, because 26 periods from here you want to find yourself with the best conditions. So if you open a long trade here, in 26 periods you already know that you will have a bullish scenario regarding the color of the cloud. This is only one of the two methods to use the Ichimoku cloud. I give to this method an importance grade of 5 out of 10. Most of times it is very reliable, but sometimes the cloud changes color even when there is a small retracement, and this is an important limit for this way of using the Ichimoku cloud. Other times there is a major change of trend with strong movements concentrated in just a few candlesticks, but the cloud changes color after a while and doesn't react immediately to the strong movements. So I believe that 5 out of 10 is a fair grade. The second way to use the cloud, the most important one in my opinion, is to simply check if the price is above or below the cloud. When the price is above the cloud, we have a bullish market. When the price is below the cloud, we have a bearish market. This also has other three main implications. The first one is that when the price crosses the cloud from below, we have a strong buy signal. The second one is when the price crosses the cloud from above, we have a strong sell signal. The third implication is that the two lines can be used as a support and resistance. The first line is a first support or resistance, while the second line is the last support or resistance available. If that one is broken, it's likely that you have a change of trend, like here for example. Periods with flat lines can also be used as support and resistance. For example, I can draw some lines here, and you can see that in this particular case it seems that these levels are quite important and acted as support and resistance. In my experience, trading this indicator, looking at the price below or above the cloud is the most important indication that you can get from the Ichimoku. I give to this concept an importance grade of 9 out of 10. We have seen all the parts that form the complete Ichimoku indicator. Now it's time to familiarize with the whole indicator. So from now on we will use the entire Ichimoku in our charts. Regarding the red line, we have seen two methods that we are not going to use. The first one is the direction of the line. It gives you an idea of the direction of the price, but since it is calculated on a period of 9 candles, you may see the line changing direction quite often, so we will not use this method. The other method is to trade the crossover with the price. Once again, this happens way too often, and we will not use this method. Last method is to use the crossover with the blue line. We have a crossover here, so this is a bullish signal. We have a crossover here, this is a bearish signal. Then we have the lines that are just close here, it's not really a signal. In general, we can say that it is bullish if the red line is above the blue line, while it is bearish if the red line is below the blue line. Anyway, we have given an importance grade for each concept and each method. This one has an importance grade of 4 out of 10, so it's not fundamental to open a position. In this lecture, I only want to have a quick look at the complete indicator. I don't want to talk about all the methods that we have analyzed and their importance. We will see this in the next lecture. Going on, we have the blue line. We have seen that it is very important, especially the direction of the blue line gives an idea of the trend. So in this case, the blue line is heading down. We will take this as a strong bearish signal. Then we have the green line, the Chico span, that is below the price, another indication that the market is bearish. Last thing to check is the cloud. We have the price below the cloud, strong bearish indication. Moreover, we have a red color in the cloud at the current price and even 26 candles from the current price. According to the Ichimoku, we are in a very strong bearish scenario. That's still nothing. Even if we remove the Ichimoku, you may find easily that we are in a bearish market. The Ichimoku is fundamental in market scenarios that are not easy to analyze, and above all, it is important to place our entry, stop loss and take profit. So for now, I only want you to familiarize with the complete indicator. In this section, we will see some buy and sell guidelines, we will analyze different market scenarios, and then in the next section, we will start to analyze the market with the Ichimoku indicator. I hope your enthusiasm is still very high because we are getting in the best part of the course. Here we have all the methods and concepts that I have expressed in the course. We have the crossover between the price and the cloud with an importance grade of 9 out of 10, the direction of the Kijun-sen, the blue line, with an importance grade of 8 out of 10, the color of the cloud with 5 out of 10, the crossover between the price and the Kijun-sen, the blue line, with an importance grade of 5 out of 10, the crossover between the Tenkan-sen and the Kijun-sen, the red and the blue line, so 4 out of 10 is the importance grade, then the crossover between the Chico span and the price with an importance grade of 4 out of 10, the crossover between the price and the Tenkan-sen, 3 out of 10, and the direction of the Tenkan-sen, the red line, with an importance grade of 3 out of 10. As I have said in a previous lecture, we will not use the last two methods, so I'm going to delete them, and we have a total of 6 methods and concepts to use with the Ichimoku. Let's analyze them one by one. First of all, the crossover between the price and the cloud. When I talk about crossover, it doesn't necessarily mean that you need to wait for the price to cross the cloud to generate a signal. As we have seen in the course, it also implies that when the price is above the cloud, we have a bullish market. When the price is below the cloud, we have a bearish market. Now, this is a fundamental condition, and especially if you are a beginner beginner, I would suggest you to follow it 100% of the times. As soon as you start to develop an eye for the indicator, you can maybe leave space for some exceptions. For example, today I was monitoring this currency pair, New Zealand dollar, Canadian dollar, on the 15-minute chart. At this point we have a shooting star. This is a candlestick pattern that may indicate a reversal point. The shooting star was followed by a strong red candle that confirmed the reversal. So here I started to think that there might have been a change of direction on the market. The price continued to go down, and here we have a first bearish signal, with the price going below the blue line. After a few candles, we have another bearish signal, with the red line crossing the blue line from above. Then we have the Chico span crossing the price from above, another bearish signal. After a few candles, the blue line is also heading down. So I started to believe that I was right and the trend was changing. Despite the price being above the cloud, I thought that it was just a matter of time to have a breakout of the cloud with the price trading below it. So I wanted to try to get a great price for my short position, and I sold before the breakout when the price was still above the cloud. I don't suggest to trade like this, especially if you are at the beginning. My suggestion is plan your long trades when the price is above the cloud and plan your short trades when the price is below the cloud. This trade that I took was just an exception, and it all started with an analysis of the candlesticks, so nothing to do with the Ichimoku. You could have entered a bit later around here. We have the price below the cloud and below the blue line, the blue line going down, the red line below the blue line, the green line below the price. The only thing is the color of the cloud that is still green, but all the other conditions are respected. So this could have been a nice short trade below the Ichimoku cloud. The second important condition is the direction of the Kijun-sen, the blue line, and I have assigned a grade of 8 out of 10 to it. This is another fundamental condition, so once again I suggest you to follow it 100% of the times. Taking the same example, you can see that here the price is under the cloud and the Kijun-sen is starting to go down. Actually, the Kijun-sen had a small change of direction already here, and then we had a flat line for a long period. The question that you may have is, what when we have a flat line? Of course, we have seen that when the line is going up, it is a bullish signal. When the line is going down, it is a bearish signal. When the line is lateral like this, it's not necessarily that the price is lateral. So I suggest to have a look at the line before becoming flat. Here we have the line changing direction and then becoming flat. I will say that there is a good chance that the trend is changing and we may see the blue line continuing to go down. Here the line is flat as well, but the previous direction was quite clear, it was going up. So in this case we can say that the market was in a clear uptrend. Now it is having a lateral phase or just a retracement, but chances are that the trend will continue and the blue line will continue to go up after this lateral phase. As we will see later on in this course, usually these are good periods to consider a buy position on the retracement. So, flat line, you need to analyze what happened before. The direction of the blue line is very important. Once again, I suggest you to trade only in the same direction of the blue line, the Kijun-sen. Now we have other four conditions. Color of the cloud with an importance grade of 5 out of 10. Crossover between the price and the Kijun-sen with an importance grade of 5 out of 10. Crossover between the Tenkan-sen and the Kijun-sen, so red and blue line, with an importance grade of 4 out of 10. crossover between the Chico span and the price with an importance grade of 4 out of 10. Provided that the two fundamental conditions are respected, do you need all the others to open a position? Not really. I can't really give you a general rule for this. I like to analyze the market chart after chart. I believe that this is also the beauty of Forex trading. Each scenario is different and you want to analyze deeply every opportunity to maximize your winning percentage. But I came up with an idea that I found out it summarizes 90% of my trading decisions with the Ichimoku. To open a position, you need to have at least other 10 importance points. This seems a bit silly and funny to say. It looks like we are playing a video game, but what I really mean is that we have 4 conditions left. We don't really want to wait for all the conditions to be satisfied, otherwise we could miss many good chances to trade. But we want to be in a good situation to open our position, so we need at least other 2 conditions for a total of 10 importance points. It may be that you have the color of the cloud and the order of price and Kijun-sen in your favor. In this case, you have additional 10 points and you can consider to open your position. In our example on New Zealand dollar, Canadian dollar, we had everything but not the color of the cloud. It's still okay because you have other 13 points supporting your trading idea. 5 for the right order of the price and the Kijun-sen, 4 for the order of the red line and the blue line, and other 4 for the right order of the Chico span and the price. So, to summarize what we have said in this video, you need the first 2 conditions. They are fundamental. Regarding the other 4, you need at least other 10 points. So, it might be the first 2 or one of the first 2 combined with the last 2. I hope it's not too confusing, but if it is, I'm sure that it will be clearer when we will analyze the market and also in the live trading section. A congestion phase is a period when the market is lateral, is trading sideways. Here on pound New Zealand dollar 4-hour chart, we have a clear example of congestion phase with the price that is in a range going up and down without a clear direction. In this situation, the Ichimoku is not very useful. Actually, if we try to have a look at it, you can get very confused. You can see that all the lines are pretty close and it is not easy to distinguish them. Let's try to have a look at the cloud without the other lines. You can see that the cloud is very tight and it changes color quite often. We have red, green, red, green, red. It's not an ideal situation to trade with the Ichimoku. In a sideways trend, the best type of indicators to use is the oscillator. For example, we can try to add the stochastic oscillator and you can trade the overbought and oversold areas, or you can trade the crossover of the 2 lines. The oscillator works very well in a sideways trend, but the Ichimoku is not very helpful and we don't want to open our trades in similar situations. With the Ichimoku, we want to plan our trades in a trending market like this. Let me add all the other lines and we can analyze this market scenario. Here we have these strong candles that give a first direction to the market. Red and blue lines start to go up, the green line is above the price is above the cloud and above the blue line, and the color of the cloud is turning green. From now on, you can see that you have a perfect situation to enter your long trade. The blue line is always heading up, or it is flat, never heading down. The price is always above the cloud and above the blue line. The cloud is green, the red line is above the blue line, and the Chico span is above the price. These were all good chances to enter your long position. Here we start to see that the blue line has its first change of direction going down. This is a first major signal that the uptrend may end. After that, the blue line heads down again here, with the price below the blue line, the red line crossing the blue line, the Chico span that is about to cross the price from above, and the price getting into the clouds. Here we don't have a clear trend anymore. Later on in this course we will talk in detail about entry and exit points, so don't worry about them right now. What you need to get from this lecture is that the Ichimoku is a powerful weapon to use in trending markets, but it's not very useful in congestion phases. In this section, we are going to analyze several charts with different time frames. I only want to show you how you can use the Ichimoku with any time frame, and it is also an opportunity to familiarize with the indicator. As I mentioned before in the course, the time frame that you should use is entirely up to you. In this lecture, we are going to use 5-minute charts. The first currency pair is Swiss franc Japanese yen. You can see that we have a clear uptrend here, even without using the Ichimoku. The second currency pair is pound New Zealand dollar. Here the price is going up and down, and it is not so easy to understand what to do. Let's use the Ichimoku to analyze both currency pairs, starting from Swiss franc against Japanese yen. First of all, the two fundamental trading concepts. The price is above the cloud and the blue line is never heading down. We are in an uptrend. For the whole time, we have the price above the blue line, the red line above the blue line, a green color of the cloud, and the Chico span above the price. This is a perfect scenario to open long positions. Right now we have the blue line that just changed direction for a while, so you can start to consider to remove your long position after a long ride. The second currency pair is pound New Zealand dollar. The Ichimoku clearly shows that we have an uptrend in the first part of the chart. The price is above the cloud and the blue line is going up. In addition, the price is above the blue line, the color of the cloud is green, the red line is above the blue line, and the Chico span is above the price. Here you have many chances to plan your long trade. Now, two questions: where you should consider to remove your long position, and when you can start to think that the uptrend is over and the downtrend begins. Here in this area you can see that you already lost many concepts that are not in your favor anymore. The price is below the blue line, the red line is below the blue line, and the Chico span is below the price. This is an area where you can consider to remove your long position. But this is not enough to say that the uptrend is over. You can say that there is a new downtrend on the market only here after this candle. The price is below the cloud and the blue line is heading down. The price is below the blue line, the red line is below the blue line, the Chico span is below the price. The only thing is that the color of the cloud is still green, even if it is turning red. Let me measure it. Let me see, 26 candles from here. Yeah, it is just about to turn red. So here you can say that we are in a downtrend and you can consider to open a short position. In this lecture we are going to see Euro Swiss franc on a 15-minute chart. In the first part of the chart, the situation is a bit confusing, with the price being just lateral and the Ichimoku not giving any clear indication. Then the price starts to go down, and I don't want to lie to you, I think I wouldn't have traded this down movement. I don't want to do like other traders who seem to catch any opportunity when they study the past charts, but then when it comes to trade the live market, it seems to be very different. In this case, there are some setups that I don't like. First of all, the color of the cloud is not clear for a long time. It seems that in this period the up and down Kumo are just overlapping, so there's no color at all. Then we have the same situation with the blue and red lines, they are just overlapping. So in this part of the down movement we don't have the additional 10 points that we need to consider a short position. We only have the price below the blue line and the Chico span below the price for a total of 9 points. A bit later we have all the conditions. Probably a good sell position could have been on this retracement here, on this candle here, but this is also an important candlestick pattern, so I think I would have just passed this opportunity. Different story for the up movement, which in my opinion is more appealing. Of course, I'm not considering any position here, the price is still under the cloud. Then we have a congestion phase with the price in the cloud, another area where I don't want to consider any position. After this area the price starts to be over the cloud, and with this candle we also have all the other conditions. The blue line is going up, the price is above the blue line, we have a green color of the cloud, the Chico span is over the price, and the only thing is the crossover of red and blue line, which is not clear here, they are at the same point for a while. Here then the red line starts to go over the blue line. So after this candle we have a good opportunity to buy this currency pair for a very good profit so far. You can see that here we still have all the conditions for a bullish market according to the Ichimoku, so you can also decide to keep your long position and try to maximize your profits. Here we have US dollar, Japanese yen on an hourly chart. The trend is clearly up, but a trade here is not as easy as it seems. First of all, let's find the moment where we could say that the currency pair started to be in an uptrend. Of course, not here that the price is below the cloud, but after the breakout we can analyze the single candlesticks and see if all the other conditions are satisfied. Starting from the first candle that breaks the cloud, we can say that the price is above the cloud and the blue line is going up, so the two fundamental conditions are satisfied. The price is above the blue line and also the red line is above the blue line. The Chico span is above the price, but we have a red color of the cloud. This is still enough to consider a long position though. The entry point then is not very hard to detect. We have almost all the conditions here, we just had a breakout, it sounds reasonable to enter a long position here, at the beginning of a potential uptrend. It is not easy to manage this position though, because we have many moments with the setup that is not bullish anymore. So let's study the first one, because I also want to mention again a concept that we have already seen in this course. We have a first important decision after this strong red candle. Let's analyze the Ichimoku. The price is in the cloud, so we can't really say if there's an uptrend or a downtrend. The blue line starts to go down, price and red line are below the blue line, the Chico span is below the price, and the only positive note is that the color of the cloud is still green, even if 26 candles from here it is starting to turn red. In such a condition, you can decide to remove your position. After this candle, you will still have a profit of 16 pips, so well done even if you quit the trade here. But do you remember what I have said about the cloud? The two lines of the cloud form good support and resistance levels, with the second line being last support or resistance available. So here it is a matter of considering pros and cons, something that we are going to study better in the risk management section. If you want to continue with this long position, it makes sense to have a stop loss that is below this support here. So let's say 5 pips below at 111.08. If the price hits the stop loss at 111.08, you would have a loss of 4 pips. Since you would sacrifice only a small amount of pips to see if the uptrend continues, I think that this is a good opportunity to move the stop loss at 111.08 and keep your position instead of taking your profit now. Of course, it would have been different if this last support had been 100 pips away from the price. I would have thought twice before risking 100 pips just to see if the price is rejected by this support. In this case, we can opt for moving the stop loss under the support, and I want you to notice how many times you avoided to remove a great position. Here is the first time with the price that is rejected on the down Kumo. A second time here, if we go on here once again, and here for the fourth time, and now it seems that we have a rejection on the up Kumo. We were almost removing our position at the beginning with a profit of 16 pips. Now we have a profit of almost 80 pips and the position is still on the market. As you can see, being a profitable trader is not only about finding a good trend to join, you need to understand entry and exit points, and you need to consider the potential trade that you want to open in terms of opportunity that you have. That's why later on in this course you will find a section dedicated to entry and exit points and a section dedicated to risk management. Here we have a 4-hour chart. The currency pair is Swiss franc against Japanese yen. Let's have a look at the area where the price goes above the clouds. Where can we tell that we are in an uptrend and start to consider a long position? If we analyze the first candle that goes clearly above the cloud, here we miss a fundamental condition. The blue line is going down. So there's no need to go on to analyze other conditions. This is enough for us to wait before considering a long position. After the following candle, we have the price above the cloud, and this time the blue line is going up. The price is above the blue line, but the red line is not clearly above the blue line. It is hard to say, even if it seems a bit higher, but it's not really a clear situation. The Chico span is just crossing the price from below, while if we measure 26 candles from here, we can see that the color of the cloud is just about to turn green, but it's not green yet. In my opinion, here you can also enter your long position, but it is not a mistake to wait for a better situation. We have 2 red candles and then another bullish candle confirming the up movement. After this candle, we still have our 2 fundamental conditions. The price is above the cloud and the blue line is going up. The price is above the blue line and the same for the red line. Here is a bit clearer. The Chico span is now clearly over the price and the color of the cloud is a bit confusing at the current price, but 26 candles from here is green. This is a positive signal. So here we can open our long position after this bullish candle. We have a very good trade until this area here. You can see that the price is retracing and then entering a congestion phase. The most important point is after this bullish candle. You can see that the price is still over the cloud, but the blue line starts to go down. Price and red line are not clearly over the blue line, they are overlapping, not an ideal situation. The Chico span is very close to the price, but a positive note is that we still have a green color of the cloud. After this candle, you may start to think to take your profits. We took our position here at 112.20 and we are considering to quit here at 114.75, so a profit of more than 250 pips. If we want to place our stop loss below last support, we should place it here, and we are talking about almost 200 pips. Definitely not worth the risk, so here I will take my profits, or at least part of my profits. Going on, you can see that taking the profits has not been the best decision, because the price is rejected on this support, the uptrend resumes, and we miss a profit of other 300 pips more or less. If you took only part of your profits here, it was reasonable to move the stop loss below this level and continue with the long position, a very smart move in this case. If you happened to take your profits, like I would have done in this case, you need to celebrate your profit of more than 250 pips. There's no point to have negative thoughts and say, oh, I could have done better, I missed a great opportunity, etc. We make decisions every time in the Forex market. You can't always be right. You need to accept that from time to time you might be wrong, and you need to be grateful that you will still have a profit in the long period. Here we have Australian dollar against US dollar on a daily chart. I'm very happy to analyze a couple of daily charts because I strongly believe that the Ichimoku is one of the most powerful tools to analyze long-term investments. So using the Ichimoku on a daily chart is ideal if you are considering a long-term investment. Let's analyze some important movements where we could start to think about opening a short position here. The first important candle is this one, because you can see that here the price is below the cloud and the blue line is going down, so we have our two fundamental conditions. Price and red line are both below the blue line, the Chico span is below the price, but the color of the cloud is still green. Even 26 candles from here, we can see that the cloud is just about to turn red. This is enough for us to consider a short position. A second important point is here when we have the price in the cloud going up above the blue line and we also have the Chico span that is not clearly under the price. It gives the impression that it is almost about to cross the price. As we have seen before, and as we will see in the section dedicated to entry and exit points, you can use the second line of the cloud as last resistance and place your stop loss just slightly above the line. So here it makes sense to have a stop loss that is above the cloud around 0.80. You may think that it is a huge stop loss because we opened our position around 0.7750, but 250 pips for a long-term investment is not that much, and you can also see it comparing the potential loss with the potential profit that you can have on the market. The price right now is almost at 0.7150, so we are talking about almost 600 pips as a potential profit so far. Going on with our position, you can see that after that moment of indecision, your trade goes smoothly until here, where we have another tough area that requires us to make a decision once again. Here the price is going towards the cloud, but the bad news is that the blue line is going up now. After this candle we are at 0.7650. If we want to move our stop loss, we can reasonably move the stop loss above the cloud here around 0.7730. We are talking about 80 pips that we may potentially sacrifice to see if the downtrend continues. I think that it is a very good deal considering that we are trading in the long period on a daily chart. 80 pips is an amount that can be covered by a single daily candle, so it may sound like a huge amount, but for a long-term trade it's not. So here definitely I would have kept my short position, placing my stop loss at 0.7730, and in case the price hits the stop loss I will still have a profit of 20 pips because the position started with a price of 0.7750. After this period we can see that there is nothing special, no tough decisions to make. You can also appreciate here the power of the cloud working as a resistance, pushing the price down with a very good candlestick pattern here, a bearish engulfing in this case, while here we have a shooting star with the upper shadow almost hitting the cloud. A profit of almost 600 pips so far, with a promising position that will still be on the market. I also want to analyze another chart, this time not a Forex chart, so I'm going to open my playlist and what I want to analyze with you is Bitcoin. Let's see the period at the end of 2017. It is clear that we have a bullish market. The price is above the cloud, the blue line is going up, price and red lines above the blue line. The color of the cloud is not clear here, but is definitely clearer here. We have a green cloud. In addition, the Chico span is above the price. With the Ichimoku, the end of 2017 was clearly a great moment to buy Bitcoin, and actually we had a strong up movement that was even better than what we all were expecting, with the price reaching $20,000. After that, there have been some important retracements. For example, this candle pushed the price back to almost $10,000 before going up again. This was the period in which many traders were saying that Bitcoin could go to $500,000 and so on, and that this was just a normal correction of the market, but the trend was still up. This kind of statements went on and on until March 2018, when people started to realize that Bitcoin was not just in a retracement phase, but was in a downtrend. Could we understand that before March using the Ichimoku? Definitely. After this candle here, we can start to talk about downtrend. The price is below the cloud, the blue line is going down, the price and red line are below the blue line, the cloud is about to turn red, and the Chico span is clearly below the price. It is the 16th of January 2018, with the price that is still at $11,600. With the Ichimoku, you could have understood that Bitcoin and the crypto markets were in a downtrend way before other people started to realize it. When we adopt a new strategy, it often happens that a trader might be confused and asks, what if I have a signal on a time frame and totally another signal on a different time frame? So for example, what if I have a buy signal on the hourly chart but the situation is the opposite on the daily chart? In this lecture, I want to introduce two concepts on this matter. The first one is the one that I prefer: stick to a single time frame. Here we have US dollar against Canadian dollar on an hourly chart, and you can see that right now you could also think to open a long position on the market because the price is above the cloud, the blue line is flat but overall is going up. Price and red line are above the blue line, the color of the cloud is green, and the Chico span is above the price. Everything is okay to open a long position right now, right here. If we check the daily chart, you can immediately see that the price is below the clouds and the blue line is going down. What to do? The first concept is to stick to a single time frame. If you want to trade the daily chart, then analyze the daily chart. If you want to trade the hourly chart, then analyze the hourly chart. Even if the two scenarios might be different, we are talking about different positions. On an hourly chart, it is likely that your target will be about 50, 60 pips, sometimes 100 pips, but you will hardly set stop loss and take profit that go above 100 pips. On a daily chart, we have seen that your target is larger. In a previous video analyzing a daily chart, we were talking about a profit of 600 pips. So in my opinion, you can't compare two different time frames, because the way you structure your position, the duration and the trading idea will not be the same. If you're still a fan of analyzing multiple time frames, I want to introduce strategy number 2 that I have called the 3 time frame method. What you can do is to analyze 3 different time frames starting from the highest one. If the analysis shows that the market is following a trend, a clear direction on all the time frames, you can open a position. For example, you can have 3 time frames like daily, 4 hours and 1 hour. Let's analyze New Zealand dollar, US dollar. Here you can see that we clearly have a bearish market on the daily. We don't really need to analyze all the components of the Ichimoku. On the 4-hour chart, we had a strong breakout of the cloud with the price that is clearly going down. On the hourly chart, the scenario is super bearish. In this case, you can start to plan a short position because the 3 time frames point in the same direction. If you're going to use this method, I suggest you to use the smallest time frame as a reference for your position, so in this case the hourly chart. This is because timing and pricing are important, and you can read the last action of the market better on a lower time frame. It is very hard to give a generic rule about entry points, because we have seen that you can enter pretty much anytime you have 2 conditions. The first one is that the setup of the Ichimoku is in your favor, so you have the 2 fundamental conditions plus other 10 points from the other conditions. The second one is that you have a good opportunity in terms of risk to reward ratio. Of course, you don't really want to analyze any single candlestick to see if the setup gives you the opportunity to open a trade or not. So I want to distinguish 2 kinds of entries: entry after a new trend and entry joining an existing trend. A trade on a new trend is an opportunity that you usually have when the price breaks through the Ichimoku cloud. We have already seen some examples in other lectures, but I want to show you other examples here. We have pound US dollar on a daily chart, and here we have a clear breakout of the cloud with the chance to join a new trend. After this candle, we have the price below the cloud and the blue line going down. The price is below the blue line, but the red line is not clearly below it. The color of the cloud 26 candles from here is still green, even if it is about to turn red. The Chico span then is below the price. Not a clear opportunity. Maybe we can wait for the next candle, and you can see that we have the red line starting to go below the blue line and the color of the cloud turning red 26 candles from here. So we can open a short position after this candlestick. Another example of entry after the breakout is right now on the same currency pair. The breakout here is not clear as the previous one, but analyzing the current candlestick, the price is above the cloud and the blue line is going up. The price is above the blue line, the Chico span above the price, and the color of the cloud is green 26 candles from here. The only condition that we don't have in our favor is the red line that is still below the blue line, but we have enough conditions to consider a long position here on this candle. So we have seen trading opportunities trying to catch a new trend on the breakout of the cloud. A trade joining the trend is an opportunity that you usually have when you already have a clear trend on the market and the price is retracing on an important level of the Ichimoku. As important levels for this technique, we will consider the blue line and above all the first line of the Ichimoku cloud. A very good example of it is the daily chart on Australian dollar US dollar. After breaking through the cloud, the price is rejected many times at any attempt by buyers to push the price higher. Let's count all the rejections. The first one here on the blue line, a second one here on the cloud. We have then a congestion phase with a rejection on the cloud once again. Then another rejection on the blue line here, a fifth rejection on the cloud with this shooting star, and all of these are opportunities to study the action of the market and plan a short position on an existing downtrend. There are some differences between entering the market on the breakout of the cloud and joining an existing trend. I'm going to talk about the main two differences. The first one is that trading a new trend allows you to have a better risk to reward ratio most of times, but you may have a worse win-loss ratio because there is no confirmation of the strength of the new trend. The second difference is that trading an existing trend allows you to have less false signals because the market already confirmed that the trend is strong, but many times you will not have a great risk to reward ratio. This means that your win-loss ratio is usually higher, but your risk to reward ratio is lower. I tell you this if you want to focus on one of the two techniques because you think that it may suit your style better, but I use the Ichimoku to trade the new trends and also existing trends, so you will see me using both methods in the live section.